this assignment here. It says, at the beginning of the year, Hernandez Company had total assets of $800,000 and total liabilities of $500,000. Answer the following questions. Okay. Well, before we go any further, to answer the following questions, remember, the accounting equation is always going to be assets equals liabilities plus owner's equity. And remember, after each transaction, the equation has to be in balance. So if assets is $800,000, liabilities $500,000, take the difference. To get owner's equity, 800,000 minus 500,000 would be 300,000. Let's take a look at how it's going to work here. Now, so the total assets increased to $150,000. So let's add $150,000 here. So now this would make our assets $950,000 because, well, they increased. Okay. And it says, and total liabilities decreased $80,000. Okay, so we're going to decrease them by $80,000. So we see here, so when this happens, oops, bring it down here. Now my liabilities are 500,000 minus 80,000, 420,000. Now it says, well, what are my owner's equity going to be? Well, again, just like we did earlier. Take the 950,000 minus 420,000. That will leave me with 530,000. And you're going to bring it here, so we know. Oops. Right here, this went up $230,000. And now we are in balance. Okay. All right, let's continue on now the next one. Okay. Well, we know, of course, as we did earlier, owner's equity in the beginning will be 300,000. It says here, during the total year, liabilities increased to 100,000. So we see right here, bring it down. So we see liabilities is 600,000. And owner's equity decreased 70,000. Okay, so decrease that by 70,000. Okay, so we know owner's equity is 230,000. So again, well, we see here to add them up, assets equal liabilities plus equity. So if we add liabilities plus equity, that'll be 830,000. So again, we can put 30,000 here. Okay, so that'll be $830,000. Total amount of assets will be $830,000. Okay, and on to the last one now. Again, we know owner's equity is 200,000. That's what I said. The total assets decreased 80,000. Okay, so we're going to decrease assets by 80,000. Okay, so this would make our assets 720,000. And owner's equity now says increase to 120,000. So again, we come down here. So we know owner's equity now is 420,000. Now, how do we get the difference here? Well, if assets equals liabilities plus equity, well, the difference will be 720 minus 420,000. So that'll make my liabilities 300,000. Okay, and going here, it means obviously we all know liabilities decreased by 500,000 to 300,000. They went down by 200,000. Okay, so it says here we're talking about liabilities. That'll be 300,000. Okay, go down next one. Number 2. Classify each of the following items as owner's drawn, revenue, or expense. Well, first one says it. Advertising expense, that is an expense. Okay, commission revenue. Well, that's a revenue. Remember, revenue is what the company earns. What do they earn? Expense is the cost of doing business. Next one, insurance expense. So that one's straightforward. Expense. Salaries expense, same thing. Cost of doing business, expense. Right. Bergman draw, that means the owner can withdraw assets from the company, such as they can withdraw the most popular thing, cash. Or they can also withdraw certain assets, like say they want to take out a computer, a table, a chair. Okay, so that'll be owner's drawing. Okay, next one, revenue. So the revenue. And last one, utilities expense. That'll just be an expense. Okay. Let's go next one now. It says Brandon Computer Timeshare Company entered the following transactions during May 2010. Indicate whether the appropriate letter, whether each transaction result in, A, B, C, D, G, increase in assets, decrease, and so on. So that's the first one. First, computer terminals for $20,000 from digital equipment on account. Now remember, on account means you bought it on credit. It means you got it, you haven't paid for it yet. So first of all, computer terminals would increase assets. So we know it's going to be an increase in asset. But it also increases liabilities because, well, now you owe it. So it's going to be C, increase in assets and an increase in liabilities. I'm going to put C down here. And so now, it's paid $4,000 cash for May rent on storage space. The first one, well, we know it's going to decrease assets because you had to use cash. Your cash is going down. And also decreases your owner's equity because that's an expense. So it's going to be D, decrease in assets and a decrease in owner's equity. So that'll be D. Received $15,000 cash from customers for contracts billed in April. That means they owed you money on account. So first of all, you received cash. That's good. Your asset went up, except your accounts receivable, which is also an asset, went down. So it's going to be A, an increase in assets and a decrease in assets. Next one. Here it says, provide computer services to Fisher Construction Company for $3,000 cash. It means you went, you did a job, and you got paid. So we know it's going to increase your assets and also increase owner's equity because revenue increases equity. So that'll be B. Next one. Paid Northern State Power Company $11,000 cash for energy usage in May. Well, first of all, if you paid cash, obviously it's going to decrease your assets. And because you paid energy usage, which is an expense, your equity went down. So it'll be D, a decrease in assets and a decrease in owner's equity. Okay, next one here says, Brand invested an additional $32,000 in the business. So we know it's going to increase your assets because, well, you put cash in the business. It's also going to increase your equity because, well, that's your investment, your capital. Okay, so that'll be B. Okay, now it says, number 7, paid digital equipment for terminals purchased in 1. So remember from 1, you bought that equipment and you owed it. Well, now you paid for it. Well, first of all, we know it's going to decrease your assets because you paid cash for it. It also decreases your liabilities because, well, it means you owed it and now you paid for it. Okay, so that'll be E. Okay. The last one here says you incurred advertising expense for May of $1,200 on account. So first of all, if it's been incurred, not yet paid, it's going to increase your liabilities. Okay, but it also is an expense, so it decreases your owner's equity. So it'll be F, an increase in liabilities and a decrease in owner's equity because you incurred it, so your liabilities went up. But since it's an expense, your equity went down. So that'll be F. First one now says, determine this company, Jan Knapp, is the sole owner of Deer Park, public camping ground near Lake Mead, recreational, following information. She began business on January 1st with an investment of $20,000. Determine Jan Knapp's net income. Remember, net income, all it is revenues minus expenses. So I see the first revenue, $140,000. Okay. Add it to the next revenue, $50,000. Accounts payable to liability doesn't go on there. Cash on hand. Oh, and just minus the expenses. They're lumped together. $150,000. Okay, so take $140,000 plus $50,000. That's $190,000. Minus $150,000. That'll leave you with $40,000. Okay, and the last part says, complete the balance sheet for Deer Park as of December 31st, 2010. And liquidity, okay. Remember, do your balance sheets always be assets equals liabilities plus equity. So again, we'll start with the assets. Okay, and the first asset we always start with is cash. Okay, and let's see, cash is $23,000. Okay, let's see if we have any other assets. Now it says here, next one is we have supplies on hand, so that'll be also supplies, $2,500. And we also had equipment. Okay, so we had equipment. Now, there's two equipments. It says the original cost of the equipment and market value. Now, accounting purposes, at least for your financial statements, we don't take into account how much the market value is. You only want the original cost, so that'll be $105,500. Okay, let's take one last look. Revenues are done, payables and liability. We got cash, original cost of equipment, as we put market value, we omit that, and we got supplies. Okay, so next part, add them up. What are your total assets? Okay, so you take 23,000 plus 2,500 plus 105,500. Okay, so that'll leave you with 131,000. Okay. All right, that's the next part. Next part of the balance sheet of assets. Now it's time for liabilities. Okay. And we see here, liabilities are all the company's debts and obligations. Okay, and the only we have two actually. We have the payables. We have a notes payable and accounts payable. Okay, so for the notes payable is $60,000. Okay. We also had accounts payable. Accounts payable was $11,000. And we see here. Yeah, you just take it here. Oops. Total liabilities. And we see it's $71,000. All right. The next section we have is our owner's equity. Okay, now owner's equity would be the owner's capital. Okay, so that'll be Jan Nab Capital. That's the owner's name, Jan Nab Capital. Now let's take a look here. How much capital they have? Well, they started off, they said they invested $20,000 cash in the business. So that's $20,000 of capital. Except, don't forget though, they made a $40,000 profit. So that, net income is profit, add them together. So that'll be the 20,000 plus the 40,000, that'll be 60,000. And the final part here, take your total liabilities and owner's equity. Again, we add those two amounts together. That'll give you, as we can see here, 131,000. Remember, total assets always have to equal total liabilities plus owner's equity on the balance sheet. There's absolutely no exceptions. Okay. All right, everybody. Hope everybody's doing well. If you have any questions or comments, please feel free to contact me. All right, buddy. Take care.